Hey everyone, Hunter Satterfield here, one of the partners at CWA as well as the Chief Investment Officer. As always, I am joined today by my fellow partner, Brian Bortz, the head of the CWA Investment Committee, as well as Brad Sanders, the Managing Director at Tectonic Advisors. This is your July market update. For the month of July, the S&P was just down a touch at 0.1%, with global stocks down 0.3%. That's not the whole story. We'll get to that in just a second. Domestic bonds down 1.3%. We're definitely going to have Brad talk about the bond market. And then global bonds down 0.6%. So that's just for the month of July. Broadly for the year, the market continues, the stock market at least, continues to do well. One thing I do want to call attention to, despite the S&P only being down 0.1 for the month, we had swings over a 2, 3, sometimes intraday period of up 1, down 1, up a half, down 1, up 1, down 2, down 3, up 3. So a wild month overall, especially given what's going on over in Iran and sort of the geopolitical and macro environment broadly. AI also has a big push towards that. So Brian, we're starting to get calls from clients related to, hey, I do have some concerns as we head into the fall. Should I potentially go a little bit more conservative, especially in light of the vol that we're seeing here more recently? You want to talk a little bit about what your, answers are to those clients as you're fielding those questions?
Yeah, sure. Clients are calling and saying, hey, the S&P is at all-time highs. Should we be worried? Should we be pulling back? Should we be becoming more conservative? Maybe sell some stocks, increase our bond exposure? And really, we're just not doing that right now. Keep in mind that our portfolios, due to their nature of the diversification, are a lot less volatile than the markets. Just to plug a little video that Brad does on a weekly basis. He does a much more in-depth investment video each Friday. So talk to your planners about that if you guys want to see a copy of that. But in last week's video, Brad said, hey, that the equity volatility is much higher than the overall market volatility. And we are seeing that on a day-to-day basis, whether it's reacting to oil prices, what's going on in the Middle East, AI. There's a lot of things that are happening in the markets right now that are creating volatility, and our clients are calling and saying, should we do something about it? We feel like we already have done something about it by creating the portfolios and the models that we have to reduce your volatility.
Yeah, there are obviously tons of things in the broader market that could create some drawdown opportunities. But we cannot invest out of fear. We just have to remain diversified and continue sort of aiming toward the long game. Now, that being said, a lot of what we've talked about, Brad, when we talk about some of the concerns that are in the market, the bond market certainly is sort of pointing toward that.
Yeah.
We saw a really bad month for bonds. It's been a very poor year overall, just from an overall total return standpoint. You want to talk a little bit about some of the warning signs the bond market is showing us, especially as we head into the fall with continued rising inflation?
Yeah, I mean, the bond market, I guess the good news, if you want to do glass half full, is there's not a lot of credit problems in the actual bond market. So if you look at corporate bonds or other spread product, you saw some widening when the Iran war started, but you haven't really seen anything blow out. So this isn't credit related. This is all rate and inflation related. And so you have kind of a couple of dynamics. You have overseas tensions, both from Iran and a kind of a resetting of global trade that started with the tariff tantrum last year. And you just have a kind of a reshifting of global dynamics there that are kind of causing a lot of problems in the rate markets. Like some countries aren't buying as many treasuries as they were because of these tariff issues and because of uncertainty. But I think the bigger point is that with our deficits and the spending we have and accelerated spending because of the war, and then a new Fed chairman, Kevin Warsh, coming in. Every time we've had a new Fed chairman since the Fed was incepted, the market is down on average 10% over the next 6 months. So he was he was installed in May. So you're looking at like Thanksgiving. If history is our guide, the market's down about 10% between then. That's because the market doesn't like uncertainty, and you have to get used to how a new Fed chairman is going to kind of behave and guide the Fed, and more importantly, what their reaction function is going to be. And I think the problem that the bond market saw last week. And while we saw the 30-year get up over 5.2, you saw the 10-year briefly get about 4.7, is that the Fed didn't do anything last week. They had 9 people say do nothing, 3 said we should raise rates. So it was a 9-3 vote. But when Kevin Warsh did his press conference, he didn't say anything substantive. He just basically said, we're not giving guidance. We're going to let the data tell us what we're going to do, and you guys have a good day. The market hated that. Okay, and so the market's going to continue to hate that. The bond market's going to continue to be volatile until we see the Fed change some language and let you know what their reaction function is going to be. It's fine to get rid of dot plots. It's fine to get rid of the way, prior administrations did things. But you do have to throw the market a bone at some point, and you have to say, this is what we're going to do. You can't just say our inflation target's 2% and inflation's in the mid to high 3s and then just walk away, because then the market's like, well, are you going to do anything about it? And then the bond market is basically pricing in a rate hike. Like, you guys need to do this. And so you have the danger of the Fed maybe getting behind if they don't look at that and at their September meeting. So I think the odds of a hike in September, like 50-50, I think they're about 100% by December, given where things are right now.
Yeah, it's obviously a scary proposition for those that are looking to turn over their home or buy a new home, just where mortgage rates might go. We're going to speak actually to all of that. We're going to have Judson and I are going to have Brad on to the Accumulating Wealth podcast next week. So please be on the lookout for that. We also are going to be releasing our first investment newsletter for you as clients that will drop for the month of August, and that will be coming out soon as well. So stay tuned to all of that. We're here to bring you the things that we think are important and to maybe calm some of those nerves that might be out there as well as we head into the fall. So thank you so much. We'll see you next month.